This is where your money is supposed to live. Steel walls. A door that weighs more than a truck. Guards, cameras, alarms. So walk in and ask to see it. Your savings. All of it. It's not in there. Not most of it. Not anywhere in the building. By law, in America, the cash a bank must keep on hand is zero. Your savings walked out the back door the day you handed them over. They are gone. And that isn't even the strange part. The strange part is that deep down, you already knew. Everyone knows. And tomorrow morning, millions of us will line up in these lobby and hand them everything we own anyway. We're here to ask the simple question behind everything worth anything. Why money? A bank is not a warehouse for money. It is a machine that moves it. The moment you deposit $100, the bank lends almost all of it straight back out. As a mortgage, a business loan, someone else's new car. So your balance is not a pile of cash with your name on it. It is a promise, a fragile promise that the money will be there the day you ask. Which raises the obvious question. If the cash walked out the door, what happens when everyone asks for it at once? To see what keeps the whole thing standing, follow the money out the door. This system has a name. Fractional reserve banking. The bank keeps only a fraction of your money in reserve and lends out the rest. In the classic textbook example, the bank holds maybe $10 and lends 90. That 90 becomes someone else's deposit in another bank, which lends most of that out too. This is not a glitch. It is the entire engine of modern banking. In fact, in the United States, the reserve a bank is required to hold has been set to zero since 2020. The bank is betting that on any normal day, only a few people ask for their cash back. And on a normal day, that bet holds. Let me make this real. Imagine a small town with one bank. 100 people each deposit $1,000. The banker now holds $100,000 in cash, but the banker knows only a handful come in on any given day. So instead of letting that cash sit dead, the banker lends most of it to the local baker to open a second shop. The baker hires staff. Those workers get paid and deposit their money in the same bank. The town grows, idle money put to work. But notice what happened. The bank now owes 100 people their $1,000 each. And the cash to pay them all is not there. It is in the bakery. As long as nobody asks for everything at once, no one notices. Now break it. One morning, a rumor spreads through the town. People say the bank is in trouble. It doesn't have to be true, because the moment you believe others will pull their money out, the smart move is to pull yours out first. So you rush to the bank. So does everyone. And here's the trap. The bank kept only a thin slice of cash. The rest is in loans that can't be called back today. The first in line get paid. Then the cash runs out. A bank healthy yesterday is gone by lunchtime because everyone asked at once. This is a bank run. And the cruelest part is the loop. The fear of collapse is what causes the collapse. The panic makes itself true. For most of history, this was just how banking went. Boom, rumor, run, ruin. Over and over. The 1800s were pocked with panics, where frightened people emptied banks in days. A bad rumor in one town could empty every bank in the next by the end of the week. And here was the cruel part. From the sidewalk, a perfectly healthy bank and a doomed one looked exactly alike. Same stone columns, same heavy doors. So you couldn't wait to find out which was which. The moment you saw a line forming, the safe move was to join it. Fear didn't need a reason. It spread by sight alone. Then came the worst of all. After the crash of 1929, a wave of bank runs tore across America. People wanted cash, all at once, and the banks could not pay. Nearly 10,000 banks failed in the first years of the Great Depression, more than a third of every bank in the country. Picture a family arriving at the bank that held everything they had, to find the door locked. Their money wasn't stolen. It was simply gone. They lost it all. Not for anything they did wrong, but because they stood too far back in the line. And out of that wreckage came the question at the heart of this video. How do you make a promise that doesn't break the moment people stop believing? If you're enjoying this, a quick subscribe means you won't miss the next one. Now, back to it. The first fix was beautifully simple. If bank runs are caused by fear, then kill the fear. In 1933, in the depths of the Depression, the U.S. government created the FDIC, deposit insurance. The idea, even if your bank fails, the government promises your money is safe, up to a limit. Today, $250,000 per person. Now watch what that does to the panic. If you know your savings are safe no matter what, you have no reason to race to the bank at the first rumor. And if nobody races, the run never starts. The insurance barely has to pay out. Its real job isn't to refund you. It's to make sure you never feel the need to run. A fire department that stops the match. Insurance calms the depositor. But it doesn't fix the bank itself. Still short of cash on the worst possible day. So the second fix went deeper. Think back to our town bank. Its loans were good, the bakery was thriving, the workers were paid, the money would come back in time. Its only problem was timing. It simply lacked the cash on the one day everyone asked for it at once. So picture the obvious answer. Someone needs to lend it cash for a few days, just until those good loans are repaid. And there is someone built for exactly that. A bigger bank, standing behind every ordinary bank. The central bank, the lender of last resort. And the rule for doing it was written down long ago. A British writer named Walter Bagehot set it out in 1873. In a panic, the central bank should lend freely to healthy banks short on cash. Watch what that does to the run. The run only works if the cash can run out. So flood the system with enough to pay everyone in line, and the line dissolves. Make the cash effectively unlimited, and there's nothing left to race against. The reason to panic evaporates. It can't save a truly rotten bank, and isn't supposed to. A bank making terrible loans should still fail. But for a good bank caught in a bad moment, this turns a deadly panic into a quiet Tuesday. So put the safeguards together because each one was paid for in a crisis. Deposit insurance, born from the Depression, stops the fear that starts a run. The lender of last resort supplies the cash, so the line cannot drain the bank dry. And the third pillar, regulation. Rules forcing banks to hold enough capital and take fewer wild risks, with inspectors checking the books, so a bank can't quietly gamble away your deposits. No single architect ever sat down and designed this. Each major panic simply wrote one more rule into the book. The system you bank with today did not spring up overnight. It is scar tissue from every disaster before it. And for decades, it largely worked. The runs grew rare. The frightening queues outside the doors became old photographs in history books. People stopped lining up and stopped checking whether their bank was safe at all. A whole generation grew up never once doubting that the money would be there. They simply forgot the banks could fail. And that forgetting is its own kind of danger. When everyone is sure the system can't break, that's exactly when the old risks quietly creep back in. Which it turns out is precisely when you should start to worry. Then came 2008. The safeguards were real, but they had been built for old-fashioned banks, with branches and tellers and lines out the door. Quietly, the banking world had grown a shadow. Huge financial firms were behaving exactly like banks, borrowing short, lending long, but without the old protections and without the inspectors watching them. When the housing market turned, the loans went bad, and trust evaporated almost overnight. And the run came back, but in a new disguise, not crowds on the sidewalk this time. It was the giant institutions themselves, suddenly refusing to lend to each other at all. In Britain, the panic took an older, more familiar form. Crowds lined up around the block outside a bank called Northern Rock, the first run on a British bank in around 150 years. The fear of the 1800s, back on a modern street. The lesson of all of it was brutal. The marble can stand, the insurance can exist, the rules can all be in place, and trust can still crack, because trust does not live in the building, or the vault, or the law. It lives in one fragile place only, the belief that everyone else still believes. Now bring it to the present. Because the bank run just evolved. In March 2023, Silicon Valley Bank got into trouble. Word spread, not through a crowd on the street, but through group chats, social media, and venture capital networks. Nobody lined up anywhere. They just opened an app and tapped. In a single day, customers tried to pull out $42 billion. To feel how fast that is, and back in 2008, one large failing bank lost about $17 billion over 10 days. SVB lost double that in hours. The old run moved at walking speed. The new one moves at the speed of a thumb. Fours. A bank solid at breakfast can be gone by dinner. So step back and look at what a bank really is. The heavy stone columns, the polished marble floors, the vault door thick as a wall. None of it is there to hold your money. The money is already out in the world. It's all there to make you feel something. That this place is permanent, solid, safe. A bank is trust, wearing a marble building. Everything underneath runs on a single fragile fact, that everyone else still believes the same thing you do. As long as we all believe the money is there, it effectively is. The loans get repaid, the deposits stay put, the promise holds. The marble isn't the strength. The shared belief is. The marble just keeps you believing it. So, what does all this mean for you going about your day? Every time you tap your card, every time your salary lands, every time you check a balance, you are trusting a number that is not sitting in a vault with your name on it. And you do it 100 times a day without a flicker of doubt. That calm is not naive. It is the entire system working exactly as designed. The insurance, the backstop, the rules, their whole purpose is to let you never think about any of this. But here's the honest part. Those safeguards don't make a bank unbreakable. They make it unpanicked. They buy calm, force. And calm, it turns out, is the only thing holding the whole tower up. So come back to where we started. You hand a stranger everything you own, and the bank does not even keep it. And it works, not because the vault is full, but because we have spent a century building clever ways to keep everyone calm at the same time. Insurance, so you do not fear. A backstop, so the cash never runs out. Rules, so the bets stay sane. Together, they perform a kind of confidence trick, one that holds for as long as we let it. A bank in the end is a shared story about safety, told in stone. But look closer at what is actually holding all of this up. The bakery loan, your mortgage, the deposit in your account. Every single piece of it is somebody's debt. Your savings are a loan you made to the bank. The bank's wealth is the loans it made to the town. Pull the thread, and the whole calm marble world turns out to be built on one thing, an ocean of borrowing. And that ocean has a strange rule. It can never be allowed to stop growing. Because if everyone, all at once, simply paid back what they owed, most of the money in the world would vanish. Which raises the biggest question of all. Why is the entire planet running on debt? And what happens the day it stops? If you like this one, hit like and subscribe. Got a topic you want us to break down? Drop it in the comments. We're here to answer the simple question behind everything. Why money?